a 17-year-old walks into an insurance office thinking they'll get a quote around 300 a month. 30 minutes later, the number is 700. That's not a mistake. That's the reality for young drivers right now. And if you've got a kid learning to drive or heading to college, you need to know exactly why that number is so high and what actually moves it down. By the end of this, you'll understand the actual cost drivers and you'll know which decisions can cut $2,000 to $4,000 a year off what you're paying. Here's the part nobody likes. 16 to 24-year-olds crash more often and more severely than any other age group. This is an opinion. The National Highway Traffic Safety Administration and the Insurance Institute for Highway Safety have the numbers. Young drivers are slower at spotting hazards. They're distracted more often. And honestly, they take more risks. Insurance companies don't set rates based on personal judgment. They set them based on millions of claims across their entire database. Across all those claims, a 19-year-old generates significantly more insurance payouts per year than a 35-year-old. That cost has to come from somewhere, and it comes from the rates charged to young drivers. In Minnesota, this gets worse because of winter driving. Ice and snow are exactly the conditions where inexperience becomes dangerous. You add that to higher vehicle theft in parts of the Twin Cities metro and heavier traffic, and young drivers here are statistically riskier to insure than young drivers in warmer states. Here's the single biggest decision that controls your cost. If your young driver can stay on your household policy, that is almost always cheaper than them getting their own. Here's why. When you add a teen to your existing policy, the increase is just an increment on top of what you're already paying. Your household already has multi-vehicle discounts, loyalty discounts, and a bundle. The insurance company is just calculating the marginal cost of adding one more young driver to that existing setup. Compare that to writing a brand new standalone policy for that teenager from scratch. No discounts, no loyalty history, just a raw young driver rate. I see this all the time in my agency. A family comes in and thinks they'll save money by getting the 17-year-old their own policy. That's when I show them the math. A Minnesota household paying $2,200 a year becomes $3,600 to $4,200 when you add the teen. That's $1,400 to $2,000 more, but that same teen on their own policy, $4,500 to $6,500. You're looking at $2,500 to $4,500 cheaper on the parent's policy. Keep them on the household policy until they get their own place or until their driving record starts materially hurting your rates. Most people don't split off until their mid-20s anyway. One more thing that moves the needle. If your college-age driver is living away from home more than 100 miles away and doesn't have regular access to a car, ask about the student away from home discount. Most carriers will knock 30 to 40% off the young driver surcharge. The logic is straightforward. If your 19-year-old is at school in Iowa and only drives when they're home for breaks, they're not driving 9 months out of the year. The insurance company knows that. The exposure is way lower, so they price accordingly. Don't assume you automatically qualify for this. You have to ask and sometimes prove that your student doesn't have a vehicle at school. But it's real, and I see families leave thousands on the table by not bringing it up. The biggest mistake I see, families pull a 16 or 17-year-old off the parent's policy too early because they think they're doing them a favor or trying to save money. You're not. You're costing yourself $2,000 to $4,000 a year. Leave them on the household policy until life circumstances actually dictate a change. It's first home, moving away permanently, or their driving record becomes a genuine liability to your rates. Everything else is just leaving money on the table. If you've got a young driver and you want to know exactly what your options are, call us right now at 763-733-7475.